In this video, I will show you how to use the lender ready financials that I sell on Etsy and also on my website. So if you're interested in this item, please check out the link in the description. If you purchase this item on my website, it's a little bit cheaper and you get 10% discount. So check out the link in the description. So I built this template mainly for small business owners so that they could generate their own financial reports. And if they need to get a loan, when you go get a loan, you need to provide different financial statements. And mainly those are the three core financial statements. So you need to provide the balance sheet, the cash flow, and also the profit and loss statement. And so this template, what it does, it's designed to do that. So basically the user will just input the data into these yellow cells here. And then once that information is inputted, then these information will automatically be generated to the P&L, the balance sheet, and the cash flow. And then you also get a financial summary of your three financial statement, and it'll give you the current ratio and the debt to equity ratio, which is what lenders look for to see if you have health liquidity and if you're high risk or not, if you have a lot of debt, right? And then also right here in the status, it'll tell you if your financial is balanced or not. So basically this is just checking if your assets equal your liability and equity, but because we have no data right now, it's saying it's balanced because zero does equal to zero, right? And so, what is the main thing about this template and what it shines is that it could help you generate all three financial statement and mainly the balance sheet, because I think with the balance sheet, most small business owners struggle with this because the balance sheet, it always have to balance whatever your asset is. Like let's say if it's $1 million, your total liability and equity, they must equal the same. Okay, if they don't equal, then that means your balance sheet is not balanced. And in order to get this financial statement to balance is the trickiest thing in accounting if you don't have like a very extensive accounting background. Okay, so this template, what it does is that it built all these financial statements for you. So all you need to do is just input your data. So it's very intuitive. So what we'll do is first, let me just walk through all the tabs, and then after that we'll do a sample so you can see how just inputting the data will automatically create three core financial statement and the financial summary. And then we can see how all these financial tie together. All right. So if you purchase this item, you get 2, 4, 6 tabs. And then, of course, I have a disclaimer here, so make sure you use this at your own discretion. And then this start here is basically just kind of instructions for you to read through and how to input your information. And after you read through that, you can go to data input and setup. So here's where you input all your data into the yellow cell. So right here, you can just put your company name. And once you input your company name, it'll flow throughout your financial statement. So I'll keep it that one as is. And then your reporting period, you can put any date, the start date and the end date. So here I'll just put 1/1/2020 35. Okay, let's just pretend it starts from January and then it ends on 12/31/2035. Okay, so it's a whole year, 2035. And then let's say total revenue, we have 250,000. Okay, cost of goods sold would be 80,000. And then salary and wages is, let's say we paid 25,000. Marketing 16,000. Rent and lease, let's say 12,000. Utility, let's say 6,000. Or software 6,000. Utility, say 8,000. Interest on loan, let's say we pay 5,000. Depreciation expense. So if you are a business owner and you only use cash accounting, so there's two types of accounting method in the accounting world. It's either accrual or cash. And then some individual, they use a hybrid, which is they take all the best of both and then use that. But if you're like a cash accounting where you only record revenue or expenses, if you receive the cash, then you wouldn't have depreciation expense. Then you just put 0. Okay, but if you're an accrual or you're hybrid and you use depreciation expense, then you just put whatever your depreciation amount is for that period. Okay, but right now, because I'm just gonna use maybe like the hybrid, so obviously I have $2,000 depreciation expense. So this here is the other expense. So let's say if you have any expenses that's not part of this description, then you can put it there. So let's say we have another 25,000, okay, as our other expenses, and then gain loss. Let's say we sell an asset, right? And then we'll have $1,000 of gain. So usually when you input all your data here, make sure you input the information as positive, like all the numbers should be positive, except for this piece here. If you have a gain, then you can put as a positive. If it's a loss, just make sure you input it as a negative, okay? So that's just one special thing about this piece here. And it's also mentioned in the start here as well in the guide. Let's say cash in bank, it'll be, let's say we started out with 65,000, and anything that's grayed out, it automatically calculates for you, so you don't need to put that information. Account receivable, again, if you are in a cash basis, you wouldn't have AR, because AR is more like accrual, right? So AR is typically, it's like you're accruing a balance. And if you're a cash basis, you wouldn't record AR because you only record revenue when you receive the cash. So account receivable is not part of the equation. So if you are cash basis, you can leave this blank or just leave it zero. But if you use the hybrid or accrual, then you can put a balance. So account receivable, it's asking what the beginning balance is. So that means it's asking what is the beginning balance that in AR that you have as of January 1st, 2035. Okay. And then so let's say we have 65, let's say we just have 5,000, and then ending here is 6,000, and then inventory, let's say we have 14,000, and then end up with 2,000. And fixed asset, let's say cost, we have 65,000, and then the end we have 85,000. Cumulative depreciation was the beginning balance. Let's say we have 25,000. So cumulative depreciation is just basically whatever your depreciation beginning of the year, plus your depreciation expense for the period for the year, right? Beginning plus whatever you expense for the period equals your cumulative depreciation, which it calculates for you. And AP, again, if you are cash basis, you don't need to record these account payable because you wouldn't have a payable, right? If you're accrual hybrid, then you might have this. So just put in what the beginning balance is as of January 1st, 2035. So let's say you have 25,000, and then here will be 35. And then credit card, let's say you have 1,000, and they'll end up with 6,000. Loan principal, let's say you borrow 25,000, the end you got 65, so that means you borrow more. Owner contribution is basically what you contributed to your business, right? The money that you invested in your business. Let's say you invested 65,000. Owner's draw is what you took out of that business, the cash that you receive, or any kind of anything of value that you take out of that your business. Okay, so let's say you take out 25,000, and loan principal payment, so any payment that you make on the principal of the loan. Purchase of fixed asset, you purchase anything with cash. Let's say you purchase 25,000. Let's say you just purchase 5,000, and then your fixed assets 20,000, right? So it makes kind of sense because your original cost, your 20,000, your sale of your asset would be, let's say you sell for 6,000, okay? So then right now we can go and see. So after we input all this data, we can see that the balance, the profit and loss is all built out. So you can see here you have revenue, cost of goods sold, all these things that you input, and then here it'll give you the net profit. And then from here, the balance sheet is also calculated out for you. Right, so you can see it's balanced, right? It's taking all your data and it's balancing that out. So you have total asset and total liability and equity, you're in balance. And cash flow, it'll give you this information. And also in this cash flow piece is also built out, you can see. And there's one interesting thing I want to explain is the adjustment for non-cash items. So you can see if you are on accrual basis or hybrid, you will most likely have this adjustment. So what this adjustment is doing is that these are non-cash items, so it's adjusting it up or down to remove it so that you just have cash. So take for example, if you have increase in account receivable, right, you would reduce it. Why? Because when you have an increase in the account receivable, that means that there are more buyers, right, your customer holding on to their money. They haven't given you the money. That's why your AR increase, your AR balance increase. So when it increases, it means you don't have the cash yet. The cash is in the buyer's hand. So that's why you need to adjust it out of your cash, because it's not part of your cash flow yet. So that's why it's being adjusted out. So that's why when you see an increase and it's in bracket, it just means that if your account receivable is increasing, that means it has a negative effect on your cash flow, right? Because that means you haven't received the cash. Same thing with inventory, right? So if your inventory increases, what does that mean? It means that you pay money out to get that inventory or something, right? So you have to pay like cash to get the inventory, right? So if you started inventory as 1,000 at the beginning of the year, and at the end of the year you have 3,000, so that means you spend $2,000, right, to get your inventory. So when your inventory increase, it has a negative effect on your cash flow, right? So it's doing all these adjustments out for you, so it's very smart. So it creates the financial statement for you automatically. And as you can see, I want to point out, just look at this ending balance here, 186,500. You can see it goes to the balance sheet. So whatever your ending balance is, it should be your ending cash balance, right? And then the other cool thing you can see is your net profit, right here, 72,000. It goes into your balance sheet, and also it goes into your cash flow. So you can see all the numbers tie out. So you have a very professional 3 financial report that all ties out to each other. And then you can go and see in your financial summary, see it's balanced, right? Your total asset, equal liability, equity, your net profit, and everything else here. And then you have your ratio, and it'll tell you whether your ratio is healthy or you're low risk or not, right? Obviously, with the debt to equity, if you are, as you can see the formula here, if it's let's see, less than 1, then that means you're at low risk. But if it's otherwise higher than that, you're at high risk, right? So it has a formula built in to tell you whether you have healthy liquidity, acceptable liquidity, or you're at liquidity risk, okay? So all these financial statement, you can print them out. So let's say you just highlight them here, and I'm showing this to you in Google Sheets. So you can do the same thing in Excel. So you buy this template, it comes in Google Sheet and Excel. So we just highlight it and go print, go to select cell, and you can see, right? You can print this out. Let me make it smaller. So you can see, you can print this out in a PDF or just through your printer. So you can do that with all these financial statement here. So that's what so great about this template is that it could auto-generate your financial statement for you, and it does all the thinking and all the accounting for you. So I hope that this template could be of help to you, and if you think it's useful, please check it out, and you can purchase this item on my website or on Etsy. So thank you so much for watching.